Hey everyone! Welcome back to the channel. Today, we're diving into one of the most important concepts in finance and business decision-making, capital budgeting. If you've ever wondered how companies decide whether to build a new factory, launch a new product, buy new machinery, or expand internationally, this is exactly where capital budgeting comes in. By the end of this video, you'll understand what capital budgeting is, why it's crucial, and the main methods used, explained in the simplest way possible. No heavy formulas, no complicated math. Let's get started. Part 1. Section 1. What is capital budgeting? Capital budgeting simply means the process of planning and evaluating long-term investments. Think of it as the company's way of asking, should we invest our money into this project, or should we walk away? For example, imagine a company deciding whether to build a new manufacturing plant, replace old equipment, launch a new product line, invest in new technology, enter a new market. All these require big money, long-term commitments, and carry risks. So companies can't just guess. They need a structured method to evaluate these decisions. That structured method is capital budgeting. Section 2. Why is capital budgeting important? So why do businesses spend so much time on capital budgeting? Because these investment decisions can make or break the company. Here are the 3 biggest reasons. 1. Long-term impact. These decisions affect the company's future for the next 5, 10, even 20 years. A bad project can drain resources for a long time. 2. Large financial commitment. Capital budgeting projects usually require millions, sometimes billions, of dollars. A single wrong move can cost the company dearly. 3. Helps maximize shareholder wealth. A company's goal is to increase value for its shareholders. Capital budgeting ensures that money is invested where it can generate the highest possible return. So basically, capital budgeting helps companies avoid disasters and make smarter, profitable long-term decisions. Section 3. The capital budgeting process. Now let's explore the process of capital budgeting. This is how companies evaluate projects step by step. Step 1. Identifying investment opportunities. Companies gather potential project ideas from different departments like R&D, marketing, engineering, or top management. Step 2. Estimating cash flows. This includes estimating how much money the project will bring in versus how much it will cost. Don't worry, we won't go deep into calculations today. Step 3. Analyzing the project. This is where financial tools like NPV, IRR, and Payback Period come in. We'll break these down simply in the next section. Step 4. Selecting the best project. After comparing multiple projects, the company selects the option that gives the best financial return with acceptable risk. Step 5. Implementation. The approved project is executed, construction starts, machines are installed, or products are launched. Step 6. Post-completion review. Finally, companies review whether the project performed as expected. Capital budgeting isn't just about choosing a project, it's about planning, executing, and evaluating it from start to finish. Section 4. Main capital budgeting techniques. Here comes the most interesting part, the key techniques used in capital budgeting. There are several methods, but we'll cover the most popular ones. 1. Payback period. This method simply asks, how long will it take for the project to recover the initial investment? Example: no numbers. If you invest in a machine, how many years of profits do you need to pay back what you spent? Pros: simple and easy. Cons: doesn't consider the value of money over time or profits after payback. 2. Net present value. Explained simply. NPV tells us whether the project will make the company richer or poorer, after considering the time value of money. If NPV is positive, the project creates value. If NPV is negative, the project destroys value. You don't need the formula. Just remember, positive NPV equals good. Negative NPV equals reject. 3. Internal rate of return. IRR is the return percentage the project is expected to generate. Think of IRR like a project's personal interest rate. If the IRR is higher than the company's required return, the project is good. Again, no calculations needed. Companies use software for this. 4. Profitability Index. This method compares the benefits to the costs of a project. A ratio above 1 means the project is financially promising. 5. Accounting rate of return. This method looks at average accounting profit instead of cash flows. It's simple, but less accurate. Section 5. Real-life examples. Let's look at some real-world scenarios to see capital budgeting in action. Example 1. Tesla building a new gigafactory. Before building a factory, Tesla evaluates cost of construction, future profits from car sales, expected battery demand, long-term savings. They use NPV and IRR to decide if the factory is worth it. Example 2. Apple launching a new iPhone line. Apple checks production costs, marketing expenses, estimated global sales, expected profits. If the NPV is positive, Apple proceeds. Section 6. Common mistakes in capital budgeting. Even big companies make mistakes. Here are the most common ones: overestimating future cash flows, underestimating costs, ignoring risk, choosing projects based on emotion instead of data, not reviewing completed projects. Capital budgeting is the process of evaluating long-term investments. It helps companies choose profitable projects. Capital budgeting supports long-term growth and financial stability. This was part 1 of our capital budgeting series. In part 2, we'll explore advanced techniques, risks, and real-life case studies with like calculations. Make sure to like, subscribe, and hit the bell icon so you don't miss the next part. Perfect! Here's part 2 of your capital budgeting ... Section 1. Understanding risk in capital budgeting. Capital budgeting isn't just about profits, it's also about risk. Every investment has uncertainty. Markets change, costs rise, demand shifts. All these can impact the project. Types of risks companies consider: 1. Market risk. Will customers actually buy the product? 2. Financial risk. Can the company afford to fund the project? 3. Operational risk. Are there delays, technical problems, or supply chain issues? 4. Political or regulatory risk. Could government regulations or taxes impact the project? Companies often use sensitivity analysis or scenario analysis to see how changes in assumptions affect profitability. Sensitivity analysis: change one variable at a time, for example, sales volume. Scenario analysis: evaluate best case, worst case, and most likely outcomes. The goal is simple: avoid projects that might sink the company while still pursuing profitable opportunities. Section 2. Advanced capital budgeting techniques. Now let's look at some advanced methods companies use beyond NPV and IRR. 1. Real options analysis. Treats investment decisions like financial options. Allows flexibility, delay, expand, or abandon projects. Useful when uncertainty is high, like tech startups or oil exploration. 2. Adjusted present value ... Separates project value from financing effects. Helps understand impact of loans or taxes. 3. Profitability Index ... Pi equals benefits divided by costs, pi greater than 1. Gives project creates value, pi 1 gives project destroys value. 4. Risk-adjusted discount rate ... Discount rate is adjusted for project risk. Riskier projects get a higher discount rate, gives harder to approve. These advanced methods are especially useful for big, complex projects like infrastructure or multinational expansions. Section 3. Real-life capital budgeting case studies. Let's see how real companies use capital budgeting in practice. Case study 1. Amazon's fill canters. Amazon evaluates new fill centers based on expected revenue, cost, and speed of delivery improvements. Uses NPV and IRR to choose locations that maximize long-term growth. Risk analysis ensures that if demand shifts, they don't lose money on a failed center. Case study 2. Coca-Cola's new product launch. Before launching a new beverage, Coca-Cola considers market demand, production costs, brand alignment. Uses scenario analysis. Best case, product becomes global hit. Worst case, limited regional success. Decision is made only if NPV and Profitability Index are favorable. Case study 3. Tesla's battery investment. Tesla invests in advanced battery technology. Uses real options. If the technology succeeds, expand production. If not, scale down. Our ADR ensures they consider the high risk of technological failure. These examples show that capital budgeting isn't just theoretical, It's how companies make real-world decisions worth millions or billions of dollars. Section 4. Common challenges in capital budgeting. Even with all these methods, capital budgeting isn't easy. Here are some common challenges companies face. 1. Estimating future cash flows. Uncertainty can lead to errors. 2. Ignoring strategic fit. Sometimes a project looks profitable, but doesn't align with long-term goals. 3. Bias in decision-making. Over-optimism or favoritism can influence approvals. 4. Changing market conditions. A project approved today may not be viable tomorrow. Successful companies combine solid financial analysis with strategic judgment. Numbers guide the decision, but vision and experience complete it. To wrap up Part 2. Risk assessment is key. Consider market, financial, operational, and political risks. Advanced techniques like real options, RADR, and APV help with complex decisions. Companies like Amazon, Coca-Cola, and Tesla rely on capital budgeting to make high-stakes investments. Challenges include estimation errors, strategic misalignment, and bias. Capital budgeting is truly the backbone of smart business investment. The better a company manages this process, the higher the chances of long-term success. And that's a wrap on our full capital budgeting. Now you know how companies evaluate projects, manage risk, and make big financial decisions with confidence. If you found this video helpful, like, subscribe, and hit the bell so you don't miss our upcoming finance and business guides. Thanks for watching, and see you in the next video.